Hello, welcome back to How About That Crypto. You are watching your daily crypto news and updates with your host, Bitcoin Stylist on Twitter and Bitcoin Hairstylist on Instagram. I am here Monday through Friday, and I explain crypto and Web3 while keeping you up to date on all the latest. Today's news stories are all about tax. A couple is suing the IRS for what they believe is unlawful taxation of their crypto rewards. And the Responsible Financial Innovation Act aims to overhaul crypto tax, addressing these and this and other issues. I'll explain all of this, but first, if you like or don't like the content, please let me know by leaving a comment below. If you're listening on podcast, please give me 5 stars and follow. If you're watching on YouTube, please subscribe and hit the bell. Help support the channel, and it doesn't cost you anything. Just to be clear and litigious, this is not financial advice. This is for entertainment purposes only. You can use the links below to do your own research. And my prayers continue to go out to the Ukrainian people and all those affected. Hopefully this war is over sooner than later. Now, today's stories are positive after some tough news so far this week. Currently, there are some issues with crypto taxing. I'll give you an example. If you buy Starbucks with the Starbucks app, these are not taxable. If Amex gives me points and I use those points as cash to pay down my bill, that cash I used to pay down my bill or pay my debts is also not taxable. However, if I lock up my Algorand tokens in the protocols to secure the network, assist with transactions, and vote on governance, I earn a reward for that. The rules as of now say that is a taxable just like interest. Well, the parallels between earning Starbucks rewards, which are currency that only have utility in the Starbucks ecosystem. I'm going to say that again. The parallels between earning Starbucks rewards, which are currency that only have utility in the Starbucks ecosystem, and earning algo tokens for participating in governance and security are very obvious to me. To me, they are the exact same. Now, I am not the only one that sees these parallels. There is a couple suing the IRS for taxing their rewards, and I got that for you right here. So check this out. If you're listening on podcasts, the links are below. I'm doing this is the Decrypt Reports by author Jeff Benson. What the IRS court case over crypto staking taxes really means. The IRS doesn't offer much guidance for paying taxes on crypto staking rewards. A lawsuit may nudge it towards changing the rules. A couple is suing the IRS for taking their crypto rewards. A couple is suing the IRS for taxing their crypto rewards. After the lawsuit was filed, the IRS offered a refund if they dropped the lawsuit. I think this is super hilarious. Like, the IRS is trying to get one of those corporate America settlements where they have to neither admit defeat nor victory. This way, the public can only speculate as to who is right or who is wrong. The difference here is that the couple decided they would not take the settlement. The couple wants to ensure that they and others will not be taxed in the future this way. The author Jeff Benson explains staking, so crypto staking, as referring to locking up your cryptocurrency so it can be used by the network to keep it secure and validate transactions. For those who don't plan on cashing out their coins, it's a way of earning passive income. Set aside some of your coins and build a small stash of return. The IRS offers 0 rules on staking rewards. They do, however, say mining rewards are taxable at their fair market value at the time of earning them. I have a little excerpt I want to read for you, just to give you a little bit more context. Like, if you don't see the parallels between Starbucks rewards points or Amex rewards, and you're able to use it as cash to pay it down, but you don't have to pay taxes on that cash, you just get rewarded for using the credit card. Well, you get rewarded for participating in the crypto in specific crypto ecosystems by helping create security and participating in governance. Now, I don't really see the difference. Like, I'm using the credit card and they're giving rewards, and then I could pay down my bill, and it's also being transferred into cash, but that's not a taxable event. So I'm going to read some for you. The guidance clearly states, this is the IRS guidance, clearly states that Bitcoin and cryptocurrencies are taxed as property. But per cryptocurrency lobbying organization Coin Center, Joshua Jarrett is arguing that rewards should be treated as newly created property, for example, like ears of corn grown in a field, and therefore shouldn't be taxed until he sells them. So if you have a field and you plant crops and crops grow, you don't pay taxes on them because they grew from the field. Well, when you stake your coins, you get rewarded for tying up your capital, but you can't until you use them or you cash them out or trade them for another currency. They should not be taxable. It is very similar to growing something, using your money, planting something, and getting a reward for all that effort for your work and for tying up your capital. Due to the offer to settle, the crypto community is thinking this could end up being a win. We won't know until a court decides. And if the court doesn't rule in favor of the crypto couple, then they will most likely go to appeals. And I have one last excerpt from this article. Coin Center is thinking even bigger. In its eyes, an IRS backtrack could affect both staking rewards and mining rewards, both of which are most accurately described as a creation of value through one's own capital and labor, rather than the receipt of value from an employer. And I would add, rather than earning interest for putting cash in a savings account. Coin Center says the network allows users to create wealth from their own resources. It does not pay people for their labor. What are your thoughts on this? Should crypto be treated differently than other rewards for participating in a specific ecosystem? By using the Starbucks app and earning rewards, they're rewarding you for using their technology, and they benefit from you using that technology and participating in propping up their business through purchases. And also the same thing with credit cards. So why is this being treated differently? Considering everything in crypto is on an immutable ledger, it's very trackable to see when you sold your coins or swapped them for another currency. Once you utilize these coins, they are taxable. But before that, well, I think I've given you plenty of arguments for why they should not be taxed until utilized. I mean, credit card rewards, business rewards, I'm just saying. Leave a comment below. Let me know your thoughts and I will move on. All right, so the next story flows from the previous one. Decrypt report by author Jeff Benson, same author, and Decrypt. The bill from Bitcoin Senator Loomis would alter capital gains landscape for crypto. The Reasonable Financial Innovation Act is still being drafted. Loomis staffer Tyler Lindum told Decrypt what's in it. So Senator Cynthia Loomis is a Republican from Wyoming. She purchased her first Bitcoin in 2013 and has been friendly to the industry. Sure, you could say, well, now I know why. However, I'll just keep moving on. She has been working on the Responsible Financial Innovation Act since last year. The biggest aim is to give clarity over capital gains tax for mining, staking, and spending. Considering there is so little clarity from the IRS on this stuff, the bill aims to solve this problem with a real conversation and actual legislation. People participating in securing the network or helping it function are rewarded, as we discussed earlier. When you sell your crypto rewards, swap them for another currency, whether that's crypto or fiat. So if you switch Algorand for Solana, that is a taxable event because you're benefiting from the value, the increase in value of your Algorand token. But you're not benefiting from the increase in value of your Algorand token until you use it. So if you purchase something with it, that's all taxable. This is how your crypto is taxed currently. If you buy now, not for rewards, but your current crypto, if you buy and hold crypto, then you use it to buy something and that crypto has appreciated in value, you have to pay taxes on that increase in value at the time of purchase. For example, buy a Bitcoin at $10,000, wait a few years, and now it's worth 20 because that's basically what Bitcoin does historically. After a few years, it's going up. Now, buy a car for $20,000. So let me go back. Buy Bitcoin for 10,000, wait a few years, now it's worth 20,000. Buy a car for 20,000. Well, guess what? You have to pay the tax on that $10,000 difference. In addition to clarity, the bill would help people move their money from their IRA or 401k into crypto without paying penalties. You will likely only accrue penalties if you use a crypto or sell it before the age of retirement. That makes sense to me because that's exactly how the retirement plans work. Does it make sense to you? Why shouldn't you be able to invest in what you want for your retirement? It's your money. Now, I have a little excerpt from in here I would like to read for you. Finally, it seeks, so the bill seeks to codify Loomis's and Senator Ron Wyden's, who's a Democrat from Oregon. So you got a Republican and a Democrat. This is a bipartisan bill. They seek to codify the unsuccessful amendment to the $1 trillion infrastructure bill signed into law last year. According to industry advocates and Senator Loomis, a provision within that bill which defined brokers to include crypto actors was overly broad. It could be read to require Bitcoin miners and proof-of-stake validators to provide the IRS with tax information of other network users. The Responsible Financial Innovation Act would redefine broker to make clear that while exchanges and custodians are brokers, most other actors are not. Think about it. If you have a machine running processing transactions in your basement and you're getting rewarded for it, one, you shouldn't be taxed on those rewards until you use them or sell them. Two, the reality is like you're not collecting every single person whose transaction you process. You're not collecting their identification. It's not even possible. So it's kind of ridiculous that bill is even painted that way. So this would look to clarify and codify all that information. All right. So this bill is not going to get voted on until after midterms, if at all. However, it is seen as good news because the conversation is happening and is helping Congress understand realities and creating apples to apples comparisons, and the conversation is happening in a friendly way. We can embrace the idea that cryptocurrency will not get regulated out of existence. So, what do you think about all of this? Do you agree with my assessment of the news? Do you disagree? Do you have another thought? Please leave a comment below. Thank you for watching on YouTube, listening on podcasts. I really appreciate it if you subscribe and follow, give me 5 stars, like, all the stuff, all the above. It helps support the channel. It doesn't cost you anything other than a few clicks. Have a good day and hodl on.